Hey guys, what's going on? Welcome back to the channel. So in today's video, I will be talking about capital gains and capital losses whenever you sell a stock and how you can calculate what your tax bill will be based on whether you booked capital gains or capital losses. So we'll get into that in this video, guys, and I will show you a very simple way that you can calculate whether or not you have a long-term or short-term capital gain or capital loss. And I think there's some really important things that you need to understand about this whenever you are selling a stock. Because really, when you sell a stock, you are going to trigger a capital gain, a short-term, long-term capital gain, or capital loss. It can be one or the other. So it's going to be one of these four things, and that is going to impact your taxes when tax time comes around. And if you don't understand how this works and how this is calculated, you could make some mistakes that could cost you thousands of dollars. And I made these mistakes early on in my investing career, but we will get into that more in this video. Let me first show you guys how you can easily calculate what your capital gain or capital loss, whether it's short-term or long-term, how you can figure out exactly what it is. Okay, so let me get my whiteboard here. Okay, we have this whiteboard, and what I'm going to do is I'm going to draw a big box around this, and I'm going to split it into four different quadrants, if you will, four quadrants. And I will put on the top one short-term loss, and then short-term gain, and then long-term loss, and long-term gain. Okay, so as you can see here, I've put in what it is on each four of these quadrants. I've put my short-term capital loss, short-term capital gain, long-term capital loss, and long-term capital gain. And really, this is pretty easy to figure out when you sell a stock, what it falls into, because a short-term loss or gain is any position that you've held for less than 12 months. So that should be pretty easy for you to figure out. And when you go and sell, like on Fidelity, when you go look at your positions, it should tell you whether or not it's short or long. And then the loss and the gain, that's pretty easy too. If it's a loss, then you've lost money, it's a negative number. And if it's a gain, well, you've made money. Congratulations. So what we will do here is I will just give a fictitious example so that you guys can understand how this works. And then we'll go more into some things that you need to be aware of and some things that you need to make sure that you do not do if you want to maximize your tax savings when tax time comes around. Let's say that you sold right at the bottom of the coronavirus pandemic, and so you have a negative $4,000 short-term loss. And then let's say that throughout the year you took plus $1,000 of short-term gains. So what we're going to do here, before I fill in anything in the long term, what this is going to do is, the first thing you're going to do is you are going to add these two numbers together. So negative 4,000 plus 1,000 means that, and you know, this is what we're going to do. We're going to cross out this and cross out this, and then we're going to write our new short-term loss beneath this. So that means we have a short-term loss now of negative $3,000. So if you did not have any long-term losses or long-term gains, this one's pretty easy. You would just have a negative $3,000 short-term capital loss for the year. And before I go any further, I should mention that the tax brackets, this is taxed differently. So anything that's short-term is going to be taxed at your marginal tax rate. And then anything that is long-term is going to be taxed at a reduced tax rate. The nice thing about long-term gains is if you make less than $80,000 a year based on 2020 numbers, then you would pay 0% in taxes on this gain. But what that also means is long-term losses count, there's no tax savings, I should say. It's 0% savings on your taxes, because this is both 0% if you make under $80,000 a year. So the implication of this, so right now, I guess I should say right now, there's nothing long-term on here. It's just negative 3,000. So we would have a savings of negative 3,000 times our marginal tax rate, and that would be our tax savings. Now, watch this. And this is where you really have to be careful when you are trying to save money during tax time, because let's say I had negative $3,000 in tax saving, short-term losses that can be used for tax saving purposes. And then let's say I went ahead and sold right before the end of the year plus $3,000 of long-term gains. Now watch this, guys. Watch. What that means is I now have to subtract these two numbers from each other, which means instead of having negative $3,000 worth of short-term losses that I can use to save money on my taxes, this money can come straight off of my income that I've earned for the year, I've actually canceled it out by realizing long-term gains. So what that means is now I basically cross that out. And guys, this is what happened to me a couple years ago. I wasn't thinking, or I didn't realize this. No one had ever told me this. And so I had a lot of short-term losses, but then I went and liquidated a position that I was up pretty big in and realized a long-term capital gain, and that wiped out all my short-term losses. And so this is something that you really need to be aware of, and this is why I wanted to make this video, guys, because you need to be aware of how to calculate this and how all of this works. So the short-term losses and gains subtract from each other first, and then the long-term losses and gains, you add those together, but then long-term and short-term losses and gains can be used to offset one another. Now, you can also use this to your advantage. Okay, so here's the example where you can use this offsetting of long-term losses with short-term gains to benefit you. So let's say that we have a short-term loss of $0, meaning that we did not sell any short positions at a loss, and then we have a short-term gain of $5,000. And this $5,000 will be taxed at our marginal tax rate, which could be as high as 37%, depending on how much money you make. We also have $0 in long-term losses and $0 in long-term gains, which means if we left this scenario as is, we again would pay pretty high taxes on this $5,000. Now, what you can do is maybe you have a stock in your portfolio that you've held for many, many years and it's just a big loser and you want to get rid of it and you want to buy some other stocks that you think are going to perform better over the short term. So let's say instead of $0 here, you go and you sell enough long-term losses to book negative $5,000 in long-term losses. So what that means is that, so we add 0 plus 5,000. Remember, these two add together first, which means we have 5,000 here, and then we have negative 5,000 plus 0, which means that this is our number down here, right? So what that means is now these two are going to offset each other. And what that means is we come down with a tax bill or capital gains and losses, it basically zeroes out. It's $0. So what that means is by realizing a long-term loss of negative $5,000, which again is no tax savings, let's say we're in the 0% long-term tax bracket, we're making under $80,000 a year, this negative $5,000 would not give us any tax savings because we're in the 0% long-term tax bracket. But by realizing this negative 5,000, we can offset the positive 5,000 short-term gain we have, resulting in a tax savings of what we would have paid on this short-term gain. So that is a way that you can use this to your advantage. You can use this strategy to make money, or I guess this, honestly, when we talk about taxes, it's not really, I would say the better option is to never sell your stocks. Not selling, you're never going to have to worry about this. And ideally, we're buying stocks that over the long term are going up. So ideally, if you keep putting money into your portfolio and you hold good stocks, you should only have long-term capital gains that you're realizing. And this is the most advantageous tax area to be in, to only have long-term gains in your portfolio, because then when you sell, you're getting the best tax rate. But if you do, for some reason, have a lot of short-term gains, let's say that you bought cruise and airline stocks earlier in the year and they went up, I think 160%, 150%, and you decided to take some profits, that's great, but you're going to pay a lot in taxes on that money. So like I said, if you have some positions in your portfolio that are long positions and maybe they've just not performed well, the stocks haven't performed well for you, then you can take those losses and offset your gains, and you can redeploy this money that was in a losing stock into a better opportunity. But really, when we talk about taxes, it's not necessarily the best idea to sell a stock just to try to game this system, to try to save money on taxes, because you're only going to save what your tax rate is times the amount of money that you're up or down. So for example, a short-term loss, you're only going to save, let's say I'm in the 22% tax bracket. Well, I would only save 22% of my loss. So if I lost $1,000 by investing in the stock market as a short-term loss, I would only save or get back 22% of that money in tax savings. So it could be advantageous for me to hold on to that stock if I think it's going to recover. But guys, these are things you will learn more as you invest more. And really, it's very important to understand this. And I think there are probably a lot of investors out there who would call themselves advanced or intermediate investors who don't realize that this is how the capital gains works. So again, one more time, you're going to add up these two, the short-term losses and gains, and then you are going to add up separately the long-term losses and long-term gains. And then you will offset, you can use losses and gains of differing types to offset one another. Now, something I didn't mention, and I guess I should throw it in now, is let's say that you had, let's go ahead and get rid of this down here. So if you had $0 in short-term or long-term losses and short-term losses, $0, then here you would pay your marginal tax rate on this $5,000, and then you would pay 0% on this $1,000 if you were under the $80,000 a year tax bracket. So here you can see that the short-term gains and long-term gains don't add together or cancel out in any way. It's just, this is your short-term gain, this is your long-term gain. The same thing over here, you might have $3,000 worth of short-term losses, and then you might have $1,000 worth of long-term losses, and they're not really going to cancel out. So playing this, the best way to play this is like I showed you, when you have short-term gains that you can cancel out with long-term losses, and what you really, really want to avoid is having long-term gains that cancel out your short-term losses. That's really what you want to avoid here. And if you guys can do that, I think you can save a lot of money on your taxes, and you can impress your friends and stuff when you start talking about capital gains and how they offset one another and marginal tax brackets and all of that fun investing stuff that makes you sound really smart. So thank you so much for watching. If you guys enjoyed this video, make sure to hit that subscribe button and the like button, because I'm sure there are a lot of people out there on YouTube that don't know about these things, and I want to encourage you and to help you become a more competent investor. So thanks so much for watching, guys, and I'll see you in the next one.